Welcome to Infinite Returns, Commercial Real Estate Investing. Brought to you by Infinity Commercial Capital. We help people find money. We are investors, lenders, and financing advisors. And this podcast is about real estate investing and helping you. Whether it's investing in residential rental properties or commercial properties, we talk about lending and all things real estate. From newbie to experienced, from funding to the strategy it takes to find success. Welcome your host, Karl Baker.
Welcome everybody to another episode of Infinite Returns, a show about real estate investing. My name's Karl Baker, the host of the show, the CEO of Infinity Commercial Capital, the show's sponsor. We talk about, we help people find money. More about our show later. Again, my name's Karl Baker, the CEO. I'm a licensed CPA, a real estate investor, a business consultant. Been doing what I do a long time and just looking forward to this episode. Don't forget to hit subscribe or like so that you see this content on your chosen platform, and thank you very much for that. Today, my guest is Tom Gazaway, the CEO and founder of LenCred. LenCred is a company that helps business owners and real estate investors find the working capital they need to advance their cause. So I'm looking forward to this conversation, and say hello, Tom, introduce yourself, and tell us about your favorite cause as well.
Hey, thanks, Karl. Really appreciate you guys having me, and looking forward to having this conversation today. So yeah, as Karl said, my name is Tom Gazaway. I'm a husband and father of three, and about 15 years ago, we started a business, and we help startups, early stage entrepreneurs, and real estate investors to access $25,000 to $250,000, oftentimes more as well, in low-cost financing that doesn't require any collateral. We use our proprietary software to do that. And so in terms of what LenCred does, that's a little bit about us. In terms of kind of me, probably my favorite cause or causes over the years have been, about anything that empowers, encourages, and lifts up disenfranchised communities. We've done a lot with, single parents and any community that's in any way disenfranchised. We love bringing education and encouragement and lifting them up. And I've done that in my 20s. I spent my whole 20s doing that on a day-to-day basis. And so we use some of our resources nowadays to continue to kind of pour into those communities that, are certainly sometimes considered the least, the last, and the forgotten. So that's the stuff that gets my wife and I excited, Karl. But thanks for having me today.
Well, looking forward to it. When I started this podcast, of course, you start to think about who you want on the guest in terms of specific names or ideas. And of course, I don't know all my future guests, but certainly you, Tom, made the short list. You and I have worked together a lot. I've actually had many of my clients come to your firm, and I feel real strongly about the subject we're going to talk about today. So I've been looking forward to this a lot. We are going today to talk about working capital, the concept of business leverage, and the right way to use leverage in the real estate space. Here's a hint. It's actually applicable for business, any business owner, but the listeners of this podcast are real estate focused. So that's what we'll be talking about. But Tom, talk about leverage. Talk about how does leverage work with financing for a business with a real estate investor? Talk about that, and then we'll go from there.
That's great. I think it's a good starting point, Karl, whenever you're talking about any business that needs financing. And so sometimes this may be considered almost elementary, but when we talk about financing, the people who use financing and get the most out of it tend to be people who know exactly what leverage is. They understand this. They understand why they use financing, why they use leverage, where it fits into their kind of long and short-term, financial and investment goals, for their business. And ultimately their goals, tend to normally include things like, their freedom, financial health, independence, and things like that. So understanding leverage on a kind of basic building block level, I think is really important. And, what is it? Well, leverage is nothing more, than the concept of achieving more with less, right? That's really what leverage is. If you apply leverage to a large boulder, you can move that boulder, you can shift it, you can make it go somewhere that in a way that you wouldn't be able to if you depended completely on your own strength, right? And that's the idea of what leverage is. In the same sense, you ask, how does it apply, in finance? Well, if you're familiar with what, Ray Dalio's famous YouTube video, How the Economy Works, financing is leverage, and leverage is nothing more than pulling your spending forward, right? That's all it is. I'm borrowing today from my future self, right? As kind of, I'm stealing Ray Dalio's kind of, phrases here. So that's really what we're talking about. So, if you understand that fundamental purpose of financing, and then you use it accordingly, what's interesting is if you do that, you're kind of well on your way to making some good financing decisions. It still can be a daunting terrain, when you talk about all of the financing options for a small business or real estate investor. That terrain can be somewhat daunting, especially if you're in your first few months of being an investor. But when it's used properly, financing can be very powerful, and it can be sometimes the primary tool that helps people create wealth. For most real estate investors, the guys and gals listening to this podcast, you're a lot like people who buy franchises in that you're using financing to create wealth, right? A franchisor, right, might be doing it by buying Chili's and Taco Bells and, things like that. Franchisees, rather, might be creating their wealth by purchasing those. But you guys know, they're not paying cash for those additional locations when they buy their second and third Taco Bell and their fourth and fifth Chili's location and whatnot. They're not paying cash. So, they're using leverage to then build something, right? And in most cases, in that scenario on the franchise side, they have an exit plan 10, 20, 30 years down the road, right? Well, as a real estate investor, you're likely doing or going to do the same thing, right? You're going to use leverage to create and build wealth. It's one of the many beautiful things about being a real estate investor. It's the concept of OPM, right? Other people's money, right? We've all heard that, but sometimes this idea of understanding leverage is connecting the dots a little bit with the purpose of leverage, what is other people's money is, how do I use it, where do I use it? And so, when you use their money, someone else's money, then you can accomplish your goals a lot faster, right? So then if you can do that with debt rather than equity, right, then you're going to do it less expensively, and you're going to maintain your ownership, keep, larger piece of the pie. So in that sense, when it's done correctly, debt is a beautiful thing. Leverage is a very powerful tool. So does that make sense?
It makes sense. I've heard your explanation before, and it's fantastic. And I've used snippets of that for a couple years now, to be honest with you. But it makes a lot of sense. And we talk in terms of using debt the right way. There's a right and a wrong way. And so talk about that. Talk about the importance of working capital and using working capital the right way.
Absolutely. Yeah. I mean, at least from my perspective, Karl, I can certainly weigh in on that. And you and I have, I think, largely seen this pretty similarly over the years. And so, when we talk about, right ways and wrong ways and, what do we do with working capital? We've actually published, a white paper about this, as well, which is kind of the 6, benefits of borrowing money the right way. And we go into several things. And in my opinion, when you're a real estate investor or a business owner, one of the big misses that happens sometimes, we see this all the time. And obviously I know you do, Karl, as well. We see people borrowing money. And then when they're doing that, they're borrowing money in a way that sometimes can damage their credit scores and their credit profiles, their credit quality. It can bring, a negative spin to their debt to income ratios. And so that doesn't mean they're bad people or that they have low IQs. It just means that there's a learning curve, right, on how to do this the right way, because there is a better way where you can borrow in a low cost environment, build up the business credit, not damage the personal credit. And that separation between the business and the personal credit is at the hub. It's kind of at the center of borrowing the right way when we talk about a business owner, or in this case, a real estate investor. And then the idea of working capital is sometimes I think we need to change the way we think. We tend to be programmed, right? And I don't know what your take is on this, Karl, for sure, but we tend to be programmed to not go get financing until we need it.
Right.
And that's true for a loan, right? You don't want to get a loan.
You have to start paying interest
and have those monthly payments. Right. You don't want that before you need it. But sometimes those working capital lines of credit work in the opposite way, and that you actually want to get them before you need them.
Right.
For a couple of reasons. Number one, you want them to be ready and waiting when you do need it, in weeks or months or whatever. But the other thing is the underwriting process dictates that if you're in a hurry and you need something, then that can be a red flag in that kind of a line of credit working capital environment, in a different way than a loan product, right?
Certainly, it limits your choices to those types of loan products that underwrite quickly, and it limits your ability to find the financing you need when you're in a hurry. Not to mention the red flags that it creates. So that's certainly the case.
And Karl, we all know what fast financing means. Fast financing means expensive money, right?
Yes, it does. Right.
Yeah.
So when I talk to business owners, I tell them there are 3, and of course you could come up with more, but 3 foundational exercises to starting your business. And whether keep in mind, you're a real estate investor, but you're really starting a business. And those 3 things include getting an LLC. Most people know that. Number 2, getting a business checking account. Most people know that. But then the third thing is to start to build business credit, because without that exercise and without awareness of it, people tend to just use what they know, which is their personal credit card. And that's when things go south very quickly. So,
can I comment on that too?
Please.
So I like all 3 of those things. Here's the other thing for if you're a listener to keep in mind is, if you're working with an individual or a firm who's going to help you build your business credit, which again is great. It's that third kind of tenet that Karl's talking about. Mm-hmm. But keep in mind that the type of financing you're really going to want is going to also require kind of a PG, personal guarantee, and a review of your personal credit. So you don't want to build business credit in a silo. You don't want to do it in a standalone, that's all I'm doing kind of environment. You want to do that in concert with understanding what's going to be needed to get the financing that you ultimately want. In this case, to do either a fix and flip or a buy and hold or whatever kind of investing you're doing. So do what Karl said, but on that third tenet of building the business credit, do it in conjunction with understanding how that's going to be, working with and working alongside of, the need for your personal credit to be hopefully either where it's at if it's already excellent, or maybe improving along the way. Does that make sense, Karl?
It does. Do you want to elaborate a little bit on that and talk about the high level strategies that people should be thinking about as a next talking point?
Certainly. Yeah, I can certainly try to do that. I think that it's great when people build business credit, and the old rule of thumb that goes way back to the days of David Gass, over 20 years ago, who kind of built that business credit building space, right? And so those tenets kind of involve you, getting some net 30 accounts, and then, finding some gas cards and some, office supply kinds of, cards. And that's great, right? And no, nothing wrong with that at all, right? It's a component of that third tenet that Karl mentioned. But when you go get your loans and financing for, your first or second or third or fourth property, whatever it might be, if you're going to do that with debt, which again tends to be lower cost than private lenders and equity related solutions, debt tends to be, you have more control and it's lower cost than your personal credit or your spouse's personal credit or your partner's personal credit or your credit partner's personal credit. Somebody's credit is going to become part of that kind of acquisition strategy, right? Mm-hmm. And if you do something about that to either protect it and preserve it, if it's already excellent, you may not realize that you do want to protect and preserve what you already have if it's excellent. A lot of times people think excellent means a score, but excellent credit goes nowadays, right? Unlike, when I started this 15 years ago, it was a score and a household income, and then you got your financing. Well, nowadays, you think about it, those lenders who are loaning money, and we're talking about the unsecured world right now. Your audience is also using secured money, right? So don't confuse the two. The combination of both is kind of this perfect marriage, right? Mm-hmm. But in that unsecured world, they're going to go way beyond your score when they underwrite your request for some working capital that you're going to use to either become a cash buyer or for your down payment or possibly for your cost overruns, or maybe to minimize your draws if you're using hard money, which a lot of people do, and no shade at the hard money lenders, it's a great solution. So you can minimize those draws, which gets your project done quicker, saves you money, all those kinds of things. If you've got a little bit of this working capital that we're talking about, and in getting that, then you, your spouse, your partners, someone's personal credit is going to matter. So again, back to what I was saying, Karl, is if it's already excellent, and make sure your excellent goes beyond the score. If it's already there, then what are you doing to protect and preserve it? And then if it's not excellent, then what are you doing to improve it? And are you doing anything to bring in a credit partner, mom, dad, Uncle Louie, mm-hmm. Blah, 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 mm-hmm. so that then that can be done in a wise way that protects that credit partner and that helps you get that lower cost financing that'll either help you do your deal more profitably or it'll help you do more transactions. So is that kind of where you were going with that, Karl?
Yeah, sure. Yeah. You touched on the concept of building business credit. I've heard you say that it is more than the credit score now. It's really the credit profile. So many lenders are looking at the depth and the details of the credit profile now. What are some of the things that lenders are looking at inside that credit profile besides just the score?
Yep. That's a great question. And before I answer that question, if you think about it, for these last 10 years, all of these lenders have been building and developing and honing their underwriting algorithms, right? They, if you're going after some, say some 0% business credit or some unsecured money in some other form or fashion, most of the time, the application process is going to take you to what that lender would prefer to decision in an automated format. They're going to prefer for the majority of those submissions and applications to be decisioned in an automated algorithm-driven format, right? There's always going to be a time and a place for the manual review to come in.
Right.
But, if you think about it, right, wrong, or otherwise, if you made me your manual underwriter, I mean, Karl knows this about me, and you can see my behind me. If you're an Iowa fan, I want to approve your application. I'm already kind of prone to want to say yes to that, right?
Right.
And so we all have our have our biases, right?
Mm-hmm. Mm-hmm.
Yeah. And so the algorithm allows the lender to make data-driven, consistent decisions rather than this underwriter likes, people that are basketball fans, and this underwriter likes people that are hunting fans, and this person loves people from, the state of Washington, all those kinds of biases. We remove that in an automated environment. Mm-hmm. So yes, back to your question, right? Is
you got the Iowa in,
those?
So that's
yeah, I did. I got it in, right? So in that environment, they're looking at things beyond the score, such as how long have you had credit? How many open accounts do you have? Do you have a combination of installment credit and revolving credit, meaning, your loans, your mortgages, your car loans are installment, loans, whereas your credit cards are revolving, right? What's your utilization? And they look at utilization both in an individual format as well as on an aggregate level, right? That says, overall, this person's utilization percentage is X, but this one card is pretty tapped out. And so they're looking at that, and they're looking at the number of inquiries. A lot of times people don't realize the number one reason, if we're talking about a credit card underwriting, line of credit underwriting kind of model where there's no collateral being pledged, the number one reason for people with excellent credit to be denied in that environment is for having too many recent inquiries. And one lender might consider 1 or 2 recent inquiries to be too many, whereas another lender might consider 4, 5, or 6 inquiries to be. So the lenders have different levels of inquiry sensitivity, stuff that we kind of measure, in the background. But yes, in looking at your credit, they're going to look at your utilization, your inquiry account, how long you've had credit, how much credit you have. I'll give you an example. Let's play a game here, Karl. Let's pretend that Karl's 25 years old and I'm 55, right? A little bit of a stretch for you, Karl, but not a stretch for me, right? So Karl and I both have 750 FICO scores. All right. And let's say we both have very similar household incomes, for both of us. Well, hey, let's go apply for a 0%, intro, line of credit. Well, we both got a good chance of being approved. But here's the difference. Since Karl's 25 and he's young, he's got a car loan and 3 credit cards. Whereas me, I'm the old guy. I've had a lot more trade lines. I got a lot bigger credit profile, and I got a lot more credit cards than Karl does. And I've got credit cards that are $10, $15, $25,000 credit limit cards. Karl has 3 cards because he's the young guy, and they have $500, $700, and $900 credit limits. Right. So if we both go into underwriting and we both get approved, you got to remember, in this environment, if you're looking at these lines of credit, that don't require collateral, there's 2 decisions. Decision number 1 is, are we going to say yes or no to these requests? And if we both got pretty good credit, there's a good chance they're going to say yes. But then the second decision is, how much of a credit line are we going to give this person? And so Karl's young and good looking and strong and, awesome, but he's only shown the world on a credit report that he can manage $500, $700, $900 credit limits. So his credit line he's going to get is going to be a lot lower than the one that I'm going to get, because I've demonstrated for many years that I can manage larger credit lines. So therefore, we both get a yes for, question number 1, but then number 2 is, he gets a much different credit limit than I do, because they're looking at those other revolving accounts. They're looking at what the credit limits are, what's the highest past balance. All those factors come into play, Karl.
It highlights the fact that one needs to understand more about the scenario than just the credit score. You started that off with, each of us have the same credit score, but a credit score is only meaningful within the context of a full scenario. So I think that's a great way to explain that. One of the things that's frustrating to me about the lending world is the opaqueness, and you touched on it, but the opaqueness of each and every lender's lending appetite and underwriting appetite. Because guess what? If you go to ABC Bank and XYZ Bank and ask each of them for a line of credit, you might get a yes or you might get a no. But frankly, you're just sort of throwing stuff up on the wall, and neither lender is going to talk about the importance that they've placed on the number of inquiries, the length of time it's been between the inquiries, your utilization. They're not going to talk about that. They're not going to tell you that. And that's what's frustrating about the opaqueness of the underwriting world. So how do people navigate around that, and what's the right way they should navigate around that?
Yeah, I mean, I think that's another great question, Carl, and that's part of why we're here, right? Is we're trying to kind of help people to learn and help people get empowered, And so if you're the kind of person that wants to learn that, do it on your own, then hopefully channels like this give you some of those kind of nuggets that are helpful, and certainly there's other ways to do your due diligence. We've learned it over time, just trial and error, pulling in the data, and then really looking at what the data tells us. We're a pretty data-driven company. So, I think where people sometimes go wrong is when they hear one or two people say something and that person doesn't have a deep kind of roster of data behind what they're, promoting or sharing or telling, this is how it works. Well, that's how it works for you and your friend, who, by the way, are in the same state, in the same area, and, applied for, did something at the same time, when in fact, you're saying that this lender pulls this credit bureau. But, we obviously have a lot of data that shows if you're down in Georgia, they're going to pull a different credit bureau. And if you're, a different part of the country, they're going to pull a different credit bureau. And so there's a variety of ways to look at things. And so I think that, if you're trying to navigate this terrain, then, we have, again, we're all for people learning this and doing it themselves if that's what they want to do. But we provide a service, and, kind of like you do, where people don't want to learn those mistakes on their own. And so then if you aren't going to, if you don't want to kind of do the trial and error, figure it out over time kind of model, then there's people like, Karl and myself who can kind of step in and assist you, and we employ that kind of, thinking that, we use a CPA, just like Karl, you're an accountant, and I think you're a CPA, right? So we probably wouldn't know nearly what you would know if we tried to complete our own tax return, right? Or if we tried to do some tax planning on how to prepare for the next year and be better aligned and ready for what's coming our way. We wouldn't know all of those nuances. And so we choose to kind of say, let's not, do this with TurboTax, if that's even still a thing. I don't even know, right? Okay, right. We don't do that, right? We just say, let's find an expert in the space, and then let's let them. And so maybe in the same sense as a, real estate investor would say, well, maybe on my first deal, I'm not going to do it all by myself, and I'm going to, work with someone else who's got some experience and whatnot. And so I think there's a couple paths to take. One is, figure it out yourself and, be ready to, patch up your knees once you skin them and fall down and whatnot. And the other one is to, find somebody that you can trust and hope that they can help you navigate that terrain, with all those nuances. Last thing I would say on that would be that I think that there's probably not anything where we've moved to a world where, the internet has brought more transparency to so many things, which is great, right? There's so much information out there, that it's made certain things. It's harder for a car dealer to dupe you nowadays because of things like Carfax and online reviews, right? And if you're looking at, your life as a real estate investor, I think you'll find more transparency in the mortgage side of the transaction, that collateralized loan solution. You'll find a little more transparency there. We've yet to see any of that hit the unsecured space for a variety of reasons, where it continues to be opaque and gray and difficult, like you said, Karl.
So I was going to ask a question about and we've touched on all of this a little bit, but I was wanting to go a little deeper in a couple areas specifically. I was going to ask, what are the common mistakes that people use? But I think I'll actually flip it around and say, for a common real estate investor, whether they're getting started or not, what are some strategies that they should be thinking about? What are some ways they should be thinking about business lines of credit and how to use it effectively for their business?
I think that's another great question, Karl. Let me try my best to answer it this way, and then if it only answers part of your question, you can come back. Yeah. So what we think is the ideal scenario, you take a real estate investor who's going to purchase some 1 to 4 unit properties. pretty standard transaction, right?
Yes.
And in the real estate investing world.
Yes.
And whether they're going to buy and hold, kind of Burr model, or whether they're going to fix and flip it, whichever way they go, we think the best way to kind of, first of all, we're proponents of other people's money, right? We like the idea of utilizing someone else's money and then keeping your money as part of your liquidity and your reserves, and not exhausting it or not dipping into it too much. And I think that when you're using other people's money and you can do it on a low cost environment, then it makes that much more sense, right? It's one thing to use other people's money, but it's really expensive. That's a little bit harder to do. But so we kind of think the ideal scenario is, find yourself a little bit of your own money if you have it. Find yourself some unsecured money that's kind of waiting in the wings and ready to go. Go find your first property. And when you finance that first property, in most cases, right, you probably don't want to get that from the local bank, because normally the local bank is going to want your full financials, possibly, your firstborn sometimes, and they're going to underwrite it in a very different way versus if you're working with a lender who, I know Karl's an expert at this, certainly more than we are, working with a lender who, isn't going to require a full financial package, and they're actually built to fund investment property real estate. Because the difference between, Wells Fargo and Bank of America taking your application versus, a lender that's designed and built to do this is, Wells Fargo and Bank of America are going to ask for a bunch of unnecessary documentation that's going to cause the transaction to take longer. It's going to irritate and frustrate you, right? And then ultimately, they may or may not fund the deal. And if they do, that mortgage that they give you is probably going to show up on your personal credit report versus getting your financing from a lender who's only going to report that to your business credit as well. So we think the ideal scenario is to have that down payment that you're going to need, plus more than that, and then fund it with a lender that specializes in investment property 1 to 4 unit deals. So they actually know how to underwrite in those environments. Normally they're underwriting on 3 things. One is the deal itself. They know how to look at acquisition costs along with rehab costs. What's the ARV? And when you're done with this, what's my LTV based on the new ARV? They know that, number one. Number two, they're going to underwrite it to your experience. And some of them won't take a newbie and some of them will, but they'll underwrite it based on your experience. And then thirdly, they'll price the deal, meaning give you a rate and terms based on, in this case, normally your credit score more so than your overall credit profile. And if you have that, then you're not talking about income documentation and tax returns and P&Ls and debt schedules and all those other things that a quote normal lender is going to. So we think that, along with the unsecured working capital, is the combination that makes you a credit savvy, finance savvy real estate investor. And then you go do what you do well, which is, the property acquisition, the property rehab, things like that. Does that answer your question at all?
It does, yeah, certainly. And then specifically in that process, navigating through that process, you're obtaining the property, you're obtaining a mortgage on the property to help you own the property and to begin to give you the right to rehab it and improve the value. And then you have to finance that rehab in a couple different ways, because most lenders do that financing on a reimbursement basis. So you have to have some liquidity or access to capital in some way. You either have to have actual cash, pay your vendors, pay for your supplies, or you have to use lines of credit. And that's where a lot of people make mistakes because they don't know any better. They use their personal credit cards to fund those payments. And we teach people to use business lines of credit. First of all, we teach people that business lines of credit exist, and it's even a thing. That's a news flash for some people. There is a thing where there are credit cards that don't report to personal credit. That's just such an important strategy, an important component of the strategy that will protect
for sure.
the personal credit. As you say, to give credit to you, I use this phrase a lot now that I learned from you. Your credit is an intangible asset, and using it the right way is something that needs to be done.
And if you're a real estate investor and you learn to treat your credit as an asset, like Karl's talking about, then what that means for you is you will have an asset that allows you to do your deals more profitably and possibly scale and do more deals quicker and faster. If you take the asset and make it a stronger asset over time, then that's yours. That is your asset that helps you do every deal. I mean, we get it that, you're in a business that can make you a lot of money when you're a real estate investor. You can fix and flip a property and make $25,000, make $100,000, make certainly more than that. And so I get it, high margin, but you can also learn how to do those even more profitably, when you utilize, debt the right way. So yeah, great point, Karl.
Yeah, that's fantastic. Well, let's wrap this up, Tom. It's been a great conversation. I usually give a couple high-level talking points. The couple things that stand out in my mind as I'm listening to this is the importance of the use of leverage, other people's money to navigate through a real estate transaction, whether it's a rehab transaction or just building a portfolio. Using leverage and other people's money to build that wealth. I love the way you explain it, where you are, let's see, how did you say that? You are investing in your future self. So that's fantastic.
Yep.
And then the second thing is the use of business credit versus personal credit. Many people don't even know about that. And so I think that's a huge concept that is important. What else would you say is your final parting comments, Tom?
Well, I think, and remember, when Karl says using business credit and personal credit, don't make the mistake a lot of people make and then thinking that means you don't have to personally guarantee the business credit. When you get a business loan, probably the most desired and lowest cost business loan in the marketplace is an SBA loan.
Mm-hmm.
They're not great products for real estate investors, but just overall business credit. Every single SBA loan requires a personal guarantee. Getting business financing and business credit does not mean there won't be a PG. Yeah, there's times where if you get a gas card, at Shell, or if you get a credit card from Staples, you may not need to personally guarantee it. That's cool, right? That's great.
Mm-hmm.
We don't consider the PG to be one of the primary things, because again, you're borrowing money that you intend to pay back, right? So if you intend to pay it back, then let's not, because if you avoid the PG, you're going to get, first of all, you're going to have a tough time finding money you're looking for,
right,
and you're going to pay more money. It's going to be more expensive. So we're going to pay this money back. So let's get it in an environment where it's lower cost and it only reports to the business credit. So now I've got separation. So for me, Karl, I appreciate it. I hope that the leverage conversation was a good one. Like you said, I did steal that from Ray Dalio when I said you're borrowing from your future self, right? I think it's a good one for us to both steal, right? And then remember, yes, in an ideal scenario, you want to be using business credit, or you want to be moving in the direction where you can use a higher percentage and more of the leverage that you use becomes business credit over time. And that's where, you don't want to just stay put where you're at. If most people don't come to us kind of ready to go, right? There's normally some things that have to be done or put in place. And so if you're doing those things and you want to be moving in a direction where you can create separation between your personal and business credit, but remember, that does not mean you won't personally guarantee the repayment of the money that you're borrowing. The PG is fine, guys. We're never worried about giving somebody a PG. What you want is that separation. And then when you're doing that and you're doing it the right way, you'll be borrowing money in a low cost environment, right? One of those 6 benefits I mentioned earlier was minimizing the interest expenses that you pay with the financing that you get. So if you're borrowing money the right way, you will get low or lower cost financing. And it's okay if you can't do that today, but start working in that direction. Start putting a plan together that moves you in that direction. And, entrepreneurs, I bet on them every day of the week, Karl. They're going to figure it out. They're going to make it work. And as you figure it out, as you make it work, then that second deal, that third deal, that next deal, let's work on doing it a little bit more profitably, or doing it where you're a little bit less reliant on maybe personal funding than business funding. So
I talk to people all the time, especially newer investors. They think the financing that they qualify for today is what they're going to qualify for the rest of their life. And you have to jump in, and whatever you can qualify for now will only help you qualify for improved terms in the future as you build history. It's very important to understand.
Absolutely.
All right. Well,
without a doubt.
Very good, Tom. You and I could probably go on for another hour on this pretty easily, but eventually people will turn us off. So how do people find out more about you and your firm?
Yeah, we're LenCred. So LenCred.com if you're looking for us, LenCred.com. And like I said, this podcast and Karl will not steer you in the wrong direction either. We've worked with Karl for a long time, so he's probably as easier to reach than us. So either way is great. And hopefully, if you have any questions, shoot us either Karl or myself, info@LenCred.com. Shoot us an email, and we'll try to answer any questions that we maybe missed today.
Right. I'm also assuming people can personally find you on LinkedIn.
Absolutely.
Yeah. Right. All right. Well, very good. Sure. Well, thank you very much. Like I said, we could go on, but we have to end somewhere. It's been a fantastic conversation. I hope people have found it to be helpful. A quick plug for Infinity Commercial Capital, the show's sponsor. As I said earlier, we help people find money. We are lenders, financing advisors, providing permanent bridge and construction loan financing for commercial and residential properties. Our value proposition is that, unlike a direct lender, we represent the borrower and help them find the right funding path. So that's number one. Number two, simplified underwriting. As Tom has mentioned earlier in the show, we're less about the personal criteria as we're more focused on the subject property and the sensibility of the subject property. So just keep that in mind as you're navigating through your investment decision-making. You can find us at Infinity Com Capital, and that will be in the show notes, infinitycomcapital.com. Call us at 314-413-7745. Email at info@infinitycomcapital.com. You can also find us on all the social media platforms, YouTube, Facebook, LinkedIn, etc. We're trying to put education-based format and content out there all the time. So we're just trying to raise awareness about the right way to conduct your real estate investing. As we wrap up, make sure that you like or subscribe to the show so that you can know what our future content is. You can make comments on any of the platforms. We'll answer any questions. If you have questions, comments, if you want to be on the show, let us know, and we'll be happy to read those comments. Thank you very much for being here today. We look forward to it, and enjoy the rest of your day. Thanks a lot. Bye-bye.
Questions, comments, want to be a guest? You can reach Karl at kbaker@infinitycomcapital.com. You can find all episodes of Infinite Returns Commercial Real Estate Investing on all major podcast platforms and YouTube. Thank you for tuning in. And until next time, happy investing.